Hey guys, what's up? In this video, we're going to talk about the economic indicator that you need to know. Okay, now what do I mean by this? Let's see. All right, so we're talking about CPI. Oh, the most dreaded event. You either blow your account or make a shit ton of money as long as you know what you're doing. All right, so CPI, as we all know, it measures the monthly change in prices paid by US consumers, right, for a specific basket of goods and services. So what it's essentially doing is it's essentially looking at inflation. Okay, and as we all know, the Fed is looking to move the inflation towards 2%, and they do this by looking at the CPI as a barometer. Okay, so the CPI, as you can see, is a weighted average of prices for a basket representative of aggregate US consumer spending. So when we see the word aggregate, we're talking about the entire economy as a whole. It's taking every single data point into consideration. Okay, right. So now, how is the CPI data used? So the CPI, there are many other factors. I chose the two most relevant ones. The Federal Reserve, right? The Federal Reserve uses it to shape economic policy. So they're using, like I said earlier, the CPI value is your inflation, more or less. Okay. So they want to keep the inflation rate to 2%. So they're targeting inflation now. If, for instance, if the inflation is high, let's say 5%, they want to do everything in their power to move that 5% to 2%, and they will shape their economic policy accordingly. Okay, so they are not only looking at CPI, they're using FOMC, they're looking at interest rates, they're looking at various other things that make it an amalgamation, that makes it a culmination of different decision making that allows a certain economic policy to come forth. It can be a contractionary policy or it can be an expansionary policy. Okay, now when it comes to the financial markets, they, of course, we can see every single month, right? There's a significant reaction to CPI. So on some months we have a really big reaction, some months we don't have much of a reaction, right? So that is all dependent on what the actual data output is as per the report that comes for CPI. Okay, all right. So CPI and the dollar index. So as we spoke about with the NFP video, inside of the NFP video, we know that a positive reading for a US dollar high impact news driver will lead to a stronger dollar index, while a negative reading can have a weaker dollar index. So the same thing applies for CPI as well. Okay, and what we have to really understand is that when we look at CPI, the most important one that the Fed is going to take into consideration is the core CPI. Okay, so you can have other CPI like month on month, year on year. So that's going to affect short-term price action. Okay, that's going to affect short-term price action. And as a result, for maybe the 1 day later or 2 days later, that short-term price action is going to prevail. And then the CPI, the core CPI value, if it's, let's say, negative, it's going to cause a bearish dollar. And asset classes like Euro USD, gold, they're all going to start skyrocketing until the next high impact news driver. Okay, now let's look at some examples and then we'll move on to the September price action that we saw for CPI, just to show you all how it looks like. Okay, so now over here, I know that the chart is not that clear. I'm sorry about that. But as you can see over here, August 10th CPI release, the core CPI had no change, as you can see down as well. But the CPI year on year and the unemployment claims also, they were quite negative. But on this particular day, the focus is going to be on the core CPI. Okay, so it had no change. So if the inflation has had no change, it's more or less on the good side. So it's neutral, but it's still good. Okay, it's neutral, but it is still good. So that's going to lead to a bullish dollar index. All right. Okay. So the July 12th CPI release, you can see that the core CPI led to a negative change. So it was a negative change. So the negative change, right? It's a bearish amount. The sentiment is bearish. Okay, sentiment is bearish, as you can see, 0.2. Previous 0.4, forecast is 0.3. So it is a bearish core CPI causing price to skyrocket. Okay. Now you might say, now Sean, if they are trying to move inflation, right? If they are trying to move inflation to 2%, or if they're trying to move it down, let's say, for example, right? So if let's say inflation is 5% and they're trying to move it down to 2%, right? Then shouldn't a negative reading be good? It's a double-edged sword. Now, like I said, there's a lot of economic conditions or economic factors that we must take into consideration, because if inflation decreases, right, then the size of the revenue, maybe tax revenue, maybe company revenue, whatever, they will also decrease. Okay, so the magnitude is the number without the sign that will decrease, and that will, in the end, it will affect the bottom line of a company. Okay, so keep that in mind. Right, so now let's look at the data for September, and then let's move on to the charts. So for September, we can see that the core CPI month on month, it increased to 0.3%. Okay, it increased to 0.3%, and the CPI year on year increased to 3.7%. So if you're looking at the core CPI, then we can see that, okay, it has indeed led to an increase. Okay, they indeed led to an increase. That means the coming few days from Wednesday, Thursday, Friday, it should be bearish. Okay, so let's take a look at this. Okay, see over here. This is today's price action. Price is going up. Okay, good. I'm in a long, so that's fine. Now, if you look at the Wednesday, that's when we had CPI. That's right here. Okay, CPI release was over here. There. Okay. Now, the release gave us a bullish reading. So that means the dollar index is going to be bullish. And as you can see, we actually went down, but then we rebounded, went back up again, right? So that is normal price action stuff. We need liquidity, right? So to move down, we need liquidity. And as you can see right over here, okay, right over here, let me show it to you guys, right over here, okay, and this low, okay, this is essentially a high liquidity dealing range. Okay, so when we have a high liquidity dealing range, when price takes the low out, it's going to go for that dealing range is high there. Okay, so a high liquidity dealing range is characterized as a dealing range that has multiple change of states inside. So more than 3. So if there are more than 3 changes in the state of deliveries, it's a high liquidity dealing range. Therefore, this is a high liquidity dealing range purge, and this is the opposing target. Okay, so CPI did that, took it down, went back up. Okay, we took that out, and that means that from here we are expecting that bearishness to unfold, meaning bullish dollar, bearish gold. You can see it happen for the next 24 hours, more or less. Okay, happen for the next 24 hours, more or less, and then I'm sure there are other news events to consider. So let's take a look. Thursday, what do we have? We had USD core PPI, core retail sales, PPI, retail sales, unemployment claims. Everything over here gave us a bullish reading. So dollar bullish, yeah, but dollar bullish, but we are seeing this go up. Okay, so let's take it from Thursday, 14th of September. If you go to the dollar index, yeah, Thursday, 14th of September, let's find it. Okay, here. That news driver at 8:30, 8:15, 8:20, 8:30, from there onwards, it was a bullish dollar, right? And you can see it did go up nicely. Yeah, it's just that at that point, gold and the dollar index became decoupled for a bit. Okay, what if I look at euro? Should it work then? Yes. See, perfectly, right? So dollar goes up, that means euro should go down, forex should go down, right? So this is how you should be looking at these relationships. And if you take into consideration the CPI reading, that is over here, right? Okay, we got the bullish dollar reading, bearish euro reading. Okay, goes up, liquidity, and from here, look at the drop that we had. Okay, so when you actually take into consideration the fundamentals, okay, if you actually take into consideration the fundamentals, understanding direction, using it with my bias predictor, it becomes super easy. Okay, so I hope you found this insightful. There's a little bit of an announcement to make. I'm going to make it into another YouTube video. It's regarding how I'm going to be closing down my subscription enrollment, monthly subscription enrollment for the mentorship. And we are only going to be servicing high net worth individuals through a high ticketing, not a high ticketing, it's going to be a high ticket service. Our mentorship is going to be a high ticket service. And so that because we're trying to provide more quality education by investing in other platforms. And at the same time, we are looking for individuals that really want to learn, that want to put in the investment to learn this, and not just individuals that are going to be community hopping just to see what the hype is about. Okay, so that's our stance on students, and that's our stance on how we're going to be taking our business from here on out. High ticket service is going to be our offering from next year, most likely in the first quarter or the end of the first quarter. But I'm going to leave an entire presentation for that later on. Okay. All right, guys. So with that said, I hope you found this insightful. The next video is going to be about the London time range strategy that I shared with you guys today on Telegram. So today being the 15th of September, Friday, 2023. All right, so I'll see you in the next one. Good luck and good trading. Bye-bye.